I'm Evan Polaski, Managing Director of Investor Relations at Ashcroft Capital. And today, back with me again is Traci Wilhelm, Ashcroft's Director of Asset Management. Traci, how are you today?
I'm great. Evan, how are you doing?
I'm doing well. Thank you for spending your time and sharing some insights here as we're looking back at 2022 and a little specifically into Q4 of 2022 and start to look forward into 2023 and how we're going to get through 2023, given all the financial world headwinds that we're currently seeing. But let's just jump right into it. So why don't you provide a little background on how Ashcroft and the portfolio as a whole really performed back in 2022?
So as a whole, our portfolio very much outperformed all of our competitors in our market in general. So we experienced 17.9% rent growth year over year from December 2022 to from December 2021. So really exceptional rent growth. That's really a result of the market strength through the first 3 quarters of the year. And then we did see some declines in the fourth quarter, as everyone in the industry did, but we were still able to achieve positive rent growth, which a lot of the market indicators have said that they were starting to see some negative rent growth. So we were able to achieve positive rent growth in fourth quarter to really finish off the year from a strong position.
Okay. And what about, so rent growth was great. How about NOI? Because clearly inflation unfortunately affects expenses as well.
That's right. But we were still able to achieve really excellent results on the NOI growth. So we achieved 13.8% improvement from December 2022 from December 2021. So really the revenue obviously was the big driver of that. So it was slightly offset by some increases, particularly in utilities and payroll, which, as we all know, their payroll has increased pretty significantly over the last year. And actually the NMHC has produced some statistics that have shown that multifamily has actually increased higher than the typical national average for job increases because there's such high competition with all the new supply and the demand that's in the marketplace.
What about year-end occupancy? How are we performing in occupancy?
So we ended the year at 94% occupied, which is great. This is down about 140 basis points from the end of the year in 2021, but that's really to be expected and in line with what we're seeing from all of the market prognostications. And so all of the reporting has said that occupancy decreased and there was negative absorption in fourth quarter. So we experienced that as well. However, 94 is a very healthy spot. And what we're seeing is that at the beginning of the quarter, we started out actually at about 92.8. And since then, we've seen it grow to 94 at the end of the year and really stabilized and has stabilized since. So we had a really short-term dip, end of 3Q, beginning of 4Q. And what we've seen is that really stabilized now back in that 94 range, which is exactly where we want to be.
What were the highlights of last year? What would you and your team say were where we really performed the strongest?
So a couple of different ways. I'd first say from a geography standpoint, we saw that Georgia outperformed the market, the other markets that we're in. And now that's softened pretty significantly. They're expecting about 40,000 units of new supply over the next couple of years. So it's a huge market. So keep that in mind. It's not the same as, Austin is expecting 30-something thousand units in a much smaller MSA.
Yeah.
It is delivering over a few years. But we were able to see tremendous growth there this year. But what's interesting is that what we saw was really pretty wild swings in Georgia. So first quarter was good, second quarter was exceptional, and then third quarter started coming down, but was still great. And then fourth quarter was pretty slow in terms of growth, but still growing. So that's important. Yeah. But Dallas was kind of steady as she goes. And so we did increase pretty significantly, but we didn't drop down as much in the fourth quarter. And so while Dallas is also going to see some supply, it's not from a percentage standpoint, it's not as significant as what we're seeing in Georgia. So I think that, it's interesting to watch because we've had, quarters of really amazing rent growth in some of the markets, but then you've got the Dallas who are really just kind of just behind Georgia in terms of the annual because it's just been steady. And so we like to see that stability, and we know that that bodes well for the future. And we're really positive on 2023. I know that the capital, well, I guess we're not maybe there yet, but I think that we're going to see this continue now. It's not going to be to the tremendous growth that we've seen. I think these markets are softening a bit, but we are still expecting to see positive rent growth. It'll just be kind of back to normal. We have to remember that the 17, 18, 20% increases that we've seen over the last 2 years are unprecedented. And we're going to be back in that 3 to 4% range is great. And so we just need to reset our expectations again back to kind of the normal before the last couple of years.
What were you seeing? Where are we looking for opportunities to continue to improve?
So there are a few things that have impacted NOI that aren't necessarily what we're thinking of when we're thinking of capital markets and the debt markets and things like that. But insurance increases are a big one, a big topic in our industry right now. Many years of double-digit increases at most of these large REITs that we're seeing, and we're seeing the same. I think everyone's seeing the same. So it's beyond debt service. It's the continuation of inflation, making sure that we're really managing these expenses to the best of our ability to overcome some of these uncontrollable things like insurance and debt. So one thing that we saw in fourth quarter that we spoke with all of our lenders, and they're seeing this across their portfolios, is an increase in delinquency. And this is due to a number of reasons. I think, first of all, a lot of the rental assistance programs have expired. And so that's one thing. Second, I think that there are people who signed renewals for units that they really couldn't afford, but they knew that they wouldn't, all of the rents around have gone up that much as well. So they knew they wouldn't be able to qualify for a new apartment. So they stayed with the hopes that they could continue to pay rent, but it's just been a big challenge. So we've seen some of these things come in. I guess the other thing is that evictions have started to be processed a little bit more quickly in most of our markets, with the exception of Georgia. And so I think we're seeing all of those things combined, and we're starting to see an increase in fraudulent applications as well. So we launched a really great initiative, a new technology this year called Snapped. And this was in the fourth quarter of last year that we launched this, and we tested it out on a few properties. And what they say is that 12% of applications contain fraudulent information, and that's for fraudulent bank statements or pay stubs. And what this product does is it can detect digital alterations. So things that aren't obvious to our on-site teams can be caught by this software. And I mean, you can literally go online right now and buy personal information that will get you qualified for a unit for like $70. So it's really affordable to commit fraud these days. And so we've launched Snap to really detect that. And really on the first property that we launched it at to test it, we tested it for 2 months, and they found over 8 fraudulent applications, which this was in Georgia. And it takes you anywhere from 4 to 6 months to get someone out of the property. So if you really look at that, that's almost $140,000 that this program has saved us already at that one property alone. So we know that it's doing its job because we are finding fraudulent applications at almost every single property. And so we're really excited about this because what we're hoping to do is catch it on the front end so that we don't have the exacerbation of these delinquency issues. And we're also considering rescreening people upon renewal. And so we're looking into that to see what it would take, what it would cost us on the expense side, and then maybe what are the metrics. If it's a 1% increase, maybe we don't need to rescreen someone, but if it's a 15% increase, maybe we do. And so we're working through those parameters now and the logistics of it to see if that's something that we'll pursue. But we're, effectively, we're trying to get it on the front end before it hits our books.
Beyond Snap, were there any major, or not major, but primary initiatives on the asset management team throughout Q4 that we're really trying to improve the process on?
Sure, there's actually quite a few. So on the revenue side, we've mentioned this before when we've talked, but we continue to roll out our portfolio on the revenue management program, which is AIRM. It's a RealPage product. And so we launched half of our portfolio in 2022. We've got another 10 assets being rolled in the first week of March. So we're in the staging stage right now, and we'll be doing the training over the next couple of weeks to launch in the first week of March. And then that'll only leave about 6 properties for us to onboard probably closer to April. So we've done it in these tranches, by the way, because there's a lot of, when you roll it on, you find a lot of you might find some glitches, or you might find some pricing that you need to adjust. And it's better for us to be able to focus on a smaller group to make sure we don't have any glaring mistakes or miss out on some revenue potential. On the expense side, or on the leasing side, we launched a really great technology called Knock. And this is a leasing tool that really helps our on-site teams follow up and do lead management. So, and it gives us on the asset management side a lot of transparency into each property's performance. So if a property is struggling and we're not understanding why, we can dig in and actually go in. We can listen to phone calls that they're making to prospects. We can read emails that they're sending, because sometimes they may be. I think in the last couple of years, it's been really easy to lease up until maybe 6 months ago, and because the demand was so very strong. And so now it's anybody who joined in the last 2 years doesn't really fully understand how intense this process can be. And a lot of the people who had been in the industry before that had forgotten how intense it can be, and that you really do, it's a sales job, right? You have to follow up and follow up and follow up. And so this gives us, not only, it helps them do the follow-ups and queues up the follow-ups and alerts them when they haven't been done, but it also gives us the transparency to make sure that that's happening, and to make sure that those follow-ups are quality. Because now we're coming to the stage where you can't just say, thanks for your email, reach out to us if you have questions. It needs to say, I see you're interested in a 2-bedroom, and here's how expensive they are, and here's our availability, please come into the office. So we're able to not just track that they're following up on the leads, which is what only thing we were really able to track before, but we're able to track the quality of that follow-up to make sure that we've got our best foot forward and getting all of the potential residents in the door that we can.
Where are you seeing the opportunities in 2023 to continue to improve those operations?
Well, everything we're hearing just on a market-wide basis is that everything is expected to be a little slow for the next, stabilized, but slow for the next, 3 to 4, 5 months. Mm-hmm. And then everyone is expecting it to really pick back up in the second half of 2023. So, and this is not just in terms of, the financial markets, if you will, but it's also in terms of demand, because a lot of what we're seeing is that people are staying put because of uncertainty in their own lives. And so really the focus this year for us is expense management and continuing the progress that we've been making on that front, as well as retention of residents. So we've really put an impact, and we included in our budgets a lot of marketing money to host more resident events, to create connections with those residents, because I think we've talked about this before, but it's really important that we create those in order to create that retention. And then really just working toward a higher retention goal, so that we're not spending money on turnover. And so that we're still, if we get into a situation, which we're not really expecting, but if we get into a situation where there is negative rent growth, your renewals, if we can keep them flat, that's a positive at the end of the day. So we're really working those renewals, and customer experience is a huge piece of that. So we're really focused on increasing and creating a better customer experience this year. And then again, on really managing those expenses to overcome some of these uncontrollable increases that we've seen. So we're doing things like water audits across the portfolio. We're doing things like electricity audits across the portfolio to make sure that we have all of the appropriate systems in place, and that we're achieving any savings that we can, or if there are any small capital projects we can do to create a savings in some of those areas. Those are all the projects that we're working on to try to mitigate those expenses. We're also working on rolling out, and this has been happening over the last few months, but rolling out a lot of national vendors that we're working to get preferred pricing on, like we do on our renovations. There's no reason that we can't use some of those same companies for our maintenance supplies and maintenance contracts. So we're working on all of those things, and that's really just to really mitigate that inflationary number, and try to keep that as low as possible. We know there's not going to be a lot we can do in terms of payroll on an individual level, but we're looking at really creative solutions around staffing to see if there are any savings that we can achieve that way. And then I think, I think that there's other things that we can work on to try to mitigate some of the challenges we have. And we've sent out, for example, this is a small example, but we've sent out these sprayers to all of the properties. And so it allows you to touch up paint rather than having to paint wall to wall or a whole room. And so, because we were having a lot of troubles with matching colors because it was 2 years old, and then you had to repaint the whole unit because it looked bad. So with these sprayers, we're really able to retouch, and then it becomes, a $50 paint charge rather than an $800 paint charge. And so I think we're rolling through more initiatives like that to try where you can spend $300 to save a lot more than that. And so those things are all underway or have already been completed, but we continue to really focus on that expense management for 2023.
Greatly appreciate all your time and your insights for this quarter, and definitely look forward to connecting again at the end of Q1 so that we can kind of start to see how the year is panning out and how our crystal balls were reading.
Absolutely. Looking forward to it.
Thank you so much, Traci.
All right. Thanks.